China has been one of the world's most attractive locations for manufacturers in recent years. Foreign investment has been pouring in because of the country's huge market as well as much lower wages compared to developed countries. But other Asian nations are fast catching up. India and Vietnam, for example, are offering incentives that many investors find irresistible. For more on the investment landscape in the coming year, we're speaking now with Leon Pereira, his Group Managing Director of Spire Research. Leon, nice to have you in the program. Happy New Year.
Great to be here, Rico.
What are the trends for 2007? Will China continue to be the manufacturing hub of the world?
From the research that we do in Spire, we see that China will still remain the #1 manufacturing location in Asia, way and above going forward. But we see an increasing trend whereby foreign investors want to diversify their risks. There is a huge discussion going on in China about standardizing the national corporate tax, increasing it from the 15% that MNCs currently pay to about 25%. The RMB has been strengthening against the US dollar. So all these concerns are prompting people to look at two countries in particular, India and Vietnam. We see that they will attract a lot more attention as far as manufacturing FDI is concerned. In India,
isn't China getting scared that they're seeing more multinational corporations diversifying away from the mainland to Vietnam and India, so they should reconsider about raising the taxes?
Well, that could be a factor that weighs heavily in the national debate. They have not actually decided to increase the tax rate to 25%. It's an ongoing discussion. But it is likely that the corporate tax will increase to some extent. And of course, the development of the RMB, the exchange rate to the US dollar, is something that will proceed.
What is the volume, though, of MNCs now diversifying away from China into Vietnam, into India, into Malaysia, into Thailand? Is it in large chunks? Is it something that China should be scared about?
It is a very early stage trend. We expect that it will play out in the next 3 to 5 years. It won't give China much cause for concern. I think the point to bear in mind is that there is a great deal of manufacturing investment that needs to be made in Asia as an export platform and also for the Asian domestic market. So there will be more than enough, we feel, for China as well as for other locations.
Which particular sectors are diversifying their risks away from China and setting up in these 4 other manufacturing hubs?
Well, for export-oriented manufacturing, we see IT and electronics as one important sector, automotives, and to a certain extent pharmaceuticals, particularly the manufacturing of generic drugs, off-patent drugs.
And also in your research, regional headquarters. When you think of regional headquarters, you only think of Singapore and Hong Kong. But now it looks like MNCs are setting up 2 regional headquarters rather than just 1. Why? Isn't it more cost for them? Or is it more like it's more for the cost competitiveness?
Well, it's really the effectiveness of decision making. For regional headquarters to be effective, it needs to be close to market. And Asia is such a big, complex and heterogeneous region that it requires 2 regional headquarters. Increasingly, we see this trend among multinational companies. Singapore and Hong Kong are well positioned to be the 2 poles, Singapore for South Asia and Hong Kong really pretty much for Greater China.
All right. Leon Pereira, Group Managing Director of Spire Research. Nice to have you with us.
Thank you, Rico.